Welcome everyone. We're ready to get started on our webinar. I'm Sarah Wheeler, Managing Editor of Content Solutions at HousingWire, and our topic today is so timely, the KPIs that drive high-performance lending, sponsored by Mortgage Cadence. We will be having a Q&A session toward the end of the webinar, but we want this to be a dialogue and not just a presentation, so please feel free to submit questions throughout our time. You can do that by clicking on the Q&A icon at the top of your screen. Also, HousingWire will be sending the webinar recording and the deck to all registrants in the next 24 hours. I'm happy to introduce our two experts today, Dan Green and Pam Herrmann. Dan is the Executive Vice President of Marketing at Mortgage Cadence. With more than 35 years in the financial services and technology sectors, Dan's expertise spans from marketing to operations with an emphasis on helping customers improve their lending performance through the delivery of an exceptional borrower experience. Pam is a best-selling author and Vice President of Marketing and Chief Storyteller for Mortgage Cadence. Her book, The Customer Manifesto, was ranked #3 by Business.com on their list of excellent customer service books every business owner should read. She hosts the video show Lend Tech Briefing and the podcast Customers for Life. We're really excited to dive into this important topic, so now I'd like to hand it off to you, Pam.
Wonderful. Thank you so much, Sarah. Happy Halloween to everyone. Welcome, and thanks so much for joining us. Dan, you with me?
Pam, I'm here. How are you?
Excellent. Good, because I can't do this alone, so thank you for that. Yes, we are here to talk about key performance indicators that drive high-performance lending. And you'll want to stick around all the way to the end because we've got a couple things you'll want to take advantage of. But in the interim, let's get started. This is a concept that we're going to be sharing with you today that was originally developed by Dan when he was heading up a lending team in a distant galaxy far, far away. Right, Dan?
That's correct. Yeah, I think that's Will Smith, and I think that's the Fresh Prince from the '90s.
That's right.
And that would be about the right time. Yeah.
Well, you had an afro growing up. Did you rock the fade like this? Just out of curiosity.
No, my fade wasn't near as good. It really wasn't near as good.
Well, what Dan was looking to solve for was really he was just determined to understand exactly where the gaps and bottlenecks were with his team or their process, or their technology, or some combination thereof. And he knew that if he could track and monitor his team's progress on a month-to-month basis against a simple set of success metrics, that he could scale and grow using a predictive model, which is all the things that we want, right? So what's important to know is that if you only take one thing away from this webinar is that you will want to understand this. You can guide your staffing model. You can identify gaps and bottlenecks in your process. You can inform your decisions around new technologies and ultimately drive your strategy, which is key. Right, Dan?
It is. And, what's really interesting is, I learned this stuff in the '90s and put these 5 metrics together, working with some seasoned mortgage professionals at the time, refined them a little bit, based on what's transpired since, but essentially the same 5 metrics that worked in the '90s work today, and the only difference is a ton more insight today than I had back then, and we'll talk about some of that on the call today.
That's exactly right, because ultimately, we know a lot of lenders. We have a lot of lender clients with our technology, but there's a difference between lending and profitable lending. Those are 2 completely different concepts because you can do it or you can do it profitably, and we're here to help you connect the dots into the profitability. So that's what we're going to share with you back when Dan had an afro. And like you said, what worked then continues to work today, helping our clients outperform the MBA averages. And if you follow his advice, you too can gain market share, you can drive higher volume, you can improve your team's productivity, you can close loans faster with less frustration and for less money, and ultimately provide a frictionless borrower experience that gets them in their home faster. And that's what you want, right? You want frictionless lending, not just for them, but for your team. So let's go ahead and kick this off.
Pam,
yes, sir.
Can I just one comment on this? So Pam said, stick around to the end because there's something really important we're going to talk about right at the end. And right at the end, what we're going to talk about is the key to profitable lending and higher market share, because there is an answer. There is one thing that tends to be more important than anything else. So don't go away early.
So it's not hope and prayer.
No.
Okay, good. I like that. Okay, great. Well, let's kick this off with a quick poll. If you folks at the HousingWire side of the fence can help us out with this, we want to take a quick poll. So, yes or no? Does the idea of a death-defying roller coaster thrill you? Look at this one. Dan, do you like roller coasters?
You know, that's the one thing I don't like. In fact, probably would like them more now than I did when I was a kid. When I was a kid, I was terrified of roller coasters.
I love them. That's just me. Death-defying roller coaster. Okay, so Sarah and Talia, you guys tell me when we've got good percentage up. Can you guys share the results? Okay, look at that. This is awesome. This is super predictive. Okay, so what we're seeing in the results is that yes, 52%, no, say 48%. And what's really interesting is that when we're talking to the average population of people out there, let me close down this little window right here. When we're talking to the average individual that's out there, only 5 to 10% of individuals are risk takers by nature. And I would consider death-defying roller coasters, that's taking a risk, right? People typically do not like the roller coaster ride, and yet that's what we're subjecting borrowers to every single day when they're in the loan process with us, right? There's this unpredictability part of it. There's the heart in the throat. Is this thing going to happen? Am I going to land safely? Is every body part going to be where it's supposed to be by the end of this process? And heck, some of you may even feel like you're on a roller coaster too as you adapt to fluctuations in volume and the demand for improved productivity from your leadership. And so when you have a few points on the horizon to work towards, it creates a stable and predictable process. And that's what is required to grow your business. And you get all of this right, your borrowers downstream will have a better experience. So it really starts from your operation first in order to drive a better borrower experience. Dan, making sense so far?
It is. You know, borrower share is one of these things that I started looking at just as I did with the rest of them very early on, because I was really curious about how many people are we reaching? How many people who are available to us for a loan are we reaching every year? And it turns out, generally speaking, that we're not reaching near enough of our present retail customers. If you're a depository, you've got banking customers, and they're the ones obviously who are the nearest in potential borrowers, mortgage borrowers. And you'll find that if you look at this metric, you know, closed loans divided by the number of customers in a year, you'll find that it's relatively low. And you'll find, generally speaking, historically, it's relatively low. And this leads to all kinds of interesting questions as to why. It's a very good diagnostic, and Pam, I think we can talk a little bit about that in just a minute.
Yeah, no, that's a great way to put it. It's an excellent diagnostic to your brand equity, right? When you think about your total retail clients and then how many are actually thinking about you when they are looking to do anything around mortgage lending, this is a great pulse check, borrower share. So Dan, go speak again to that, how you calculate borrower share before we get into some results here.
Yeah, so you know, you'll find that most of these metrics are super simple to calculate. I mean, back of the envelope, basically, and that's intentional. This one is number of closed loans in a calendar year, closed first mortgage loans in a calendar year, divided by the number of customers you had in that same year. If you're a depository, that'd be your deposit, it'd be your customers, not your accounts. And you're going to find that the resulting answer is probably a pretty little number. Probably less than 1%, might be less than 0.75%. Not uncommon, you'd almost expect it, but again, really simple division.
Great, so let's go into some of the metrics. Now, just to kind of give you a preamble, at Mortgage Cadence, we have been conducting an annual client benchmarking study. And what this helps us understand here at Mortgage Cadence is how well our clients are performing on our technology, because we know when all things are equal, right? We have clients who are working off of one platform, and how is it that their people and their process dovetail and optimize the technology that get them different results. So we want to share those findings with you, and give you kind of some relativity to what this number looks like. So the benchmarking study range, as Dan said, is actually pretty low. And when I'm fairly new to the industry, it's been a couple of years for me, and I was very startled by this number. So Dan, can you talk a little bit about this?
Yeah, when you think about it, there's some reasons it's really little, and there's some reasons that we shouldn't despair over the fact that the result of the equation is tiny. Obviously, not every customer is eligible for a mortgage. When you count total customers, you're counting people who are, younger than the population who would be buying or refinancing home, and also older than the typical, home buyer or home refinancer. So there's segments on either end of the age spectrum that are included in the calculation who don't qualify. But that's okay if you're comparing yourself to a like institution, you're doing the calculation the same way. And one of the things that's cool about this calculation is the data is available to you through regulatory filings, through your financial regulator filings. So you can calculate this for yourself and for everybody else. So we don't despair that it's small. We understand that that's expected. Now, the thing is it could be bigger. We know that's the case because, as you're seeing here, the range is really wide, from 0.12% to 2.6%. Pretty broad range. It's really tough to get to 2.6%. It's honestly really tough to get above 1.5%, and that's true over the long period of time I've been doing this. So we look at the average, we say 0.85%. If you're at the average, that means you're doing, fairly well. Probably means that, product and pricing and delivery are all in pretty good shape. If you're below the average, if you're, like at 0.75%, for instance, or lower than that, then it probably means it's time to look at things like product and pricing and delivery. Why are you hitting below the average? On the other end of the spectrum, if you're way above the average, if you're at 1.5% or you're approaching 2.6%, that's a different measure of opportunity, and that's the opportunity to go find more customers to lend to.
Got it.
So I
and
look
you have
at
a different
this,
problem.
right? That's why I love this. It tells you, where do you spend your time? Do I spend my time, marketing into my current customer base and maybe tweaking product pricing and delivery at the same time to drive the average higher? Or is the average so high, I have a problem of abundance and I have to go find more customers, so I go market to the market generally. Like I said, love this because it's a measure of opportunity.
Yeah, well, and we're marketers, so we like just tapping into the wellspring. So I'm going to share with you guys a quick case study. This was a conversation that I had with a client at our user conference a year and a half ago, and I didn't know anybody. I didn't know him. So it's like, hey, what's your story? How's your business going? What's your plan for next year? And he said, well, my board has given me a directive. This was a VP of lending. And he said, my board's given me a directive. I've got to go out and grow the business by X amount. And I said, well, how much time do you have? And he said, I've got a couple of years to make that happen. I said, okay, great. So what's your plan? And he goes, well, I just want to get more of our customers borrowing from us. I said, great, that's borrow share. So how are you going to do that actually? And he goes, I have no clue. And I said, well, what you're talking about is a marketing metric. And as Dan was saying, this is just a measurement of your brand equity. So how, what is your relationship with your marketing team? And he said, it's not really great. And I said, well, this is all about traffic. Let me introduce you to somebody who can help you with some traffic. So I want to share with you guys some results of him doing a little bit of work with some traffic to their business and gain some brand awareness and some of the results from that. I don't typically like to start with results, but I want you guys to really lean into the power of the low-hanging fruit of getting your existing customers to borrow from you. So let's go through this. So June of this year, this is a smaller credit union. They were at 33 million in closing in June. That was a record-breaking month for them. The next month in July, they did 42, record-breaking month for them. August of this year, they broke July's record. They met their annual sales goal by the end of August of this summer. And they grew their loan pipeline by 122% using a pretty slick little Facebook strategy that I'm going to share with you guys. So pretty impressive numbers, right, Dan? Anytime you could, this is hard to do.
It's really difficult to do, and what Pam will show you next in terms of the Facebook strategy is incredibly powerful, and it gets right at the heart of getting to your borrower, your customer, at the moment they're looking for a mortgage. You know, if you're a depository, you may still say, or you may lament that your customers don't know that you offer mortgages. It's a pretty true statement I've heard for all the decades I've been in this business. And it finally dawned on me, I think as a result of this work Pam is talking about, is that most people don't think about a mortgage until they're in the moment. You know, most consumers, it's probably the last thing they want to think about. But when they need to think of one, they need a mortgage, and that's why the social media strategy works so well. You caught them when they're interested, not when they're not interested.
That's exactly right. So many of you know that MBA was just, what is today? Thursday? It was this
Thursday,
week.
yes.
It's all a blur. So we wanted to take this strategy that worked really effectively for one of our clients, and I wanted to just kind of test drive it with the Mortgage Cadence brand at MBA. So I'm going to share with you guys what we did and show you how this worked. So this is a map of Austin where MBA Annual was held, and you can see that the Austin Convention Center was in the middle. This red box represents a target area that we wanted to do some Facebook ads in front of. So the first thing that I did was I held up my phone and I ripped this 40-second video. I was actually standing in this atrium right behind Sarah Wheeler from HousingWire, who was recording and interviewing somebody else right behind me. You'll recognize that. But anyway, ripped this quick little video saying, hey guys, we're down on the floor. We've got some fresh macaroons. Stop by, say hello. Here are the things that we're talking about today at the show this week. Come by and say hello. So quick little video that we dropped basically right on top of this grid area that I'm showing behind the ad, okay? Basically what we told Facebook is that people with interest around lending or lending technology, those are the people that we want to target. And so what ended up happening was 912, and again, this ran for like a day and a half. 912 individuals watched the video, and that means that Facebook was able to capture the IDs for all 912 of them, right? So that means we can go forward and we can put an additional ad in front of those 912 people. We spent about $355 on ads, and that equates to about 36 cents per person within Facebook, okay? So that was kind of step one, dirt cheap way to get your brand in front of you. You can do this for your brand. Doesn't matter if you guys are a service provider, lender, doesn't matter. Any business can use this strategy, okay? So then, Dan, were you breathing in for a second?
Can I just say one thing? Because
yes,
one of the things that's also strikes me about this, not only does it catch people in the moment, and this is a classic case of Pam caught people in the moment, but if you look at the per person cost of this, it's so inexpensive. It's so much less expensive than, say, general awareness advertising that goes out to the masses. This is hitting people who are interested in the moment. It's not only the results you saw on the previous page, not only were they great for that lender, they didn't cost that lender all that much.
No, very inexpensive. That's a great point, because a lot of times, especially in local markets, they'll do billboards or print, and it's very difficult to track those results, right? It's hard to attribute a lead from a place when it's analog, but digital, this is a great strategy. So your marketing team can help you guys with this. So basically, what I wanted to do next was to take these 912 and I wanted to put an ad in front of them talking about this webinar that we're on right now. We actually engaged 826 people with a very simple Facebook ad. You can see my picture there, not a great shot right there from my ad guide, but that's okay. We got this ad in front of 826. So many of you may have seen this in Facebook, clicked on the link, and were able to register from there. So do you guys see how this works now? This becomes a little bit of what we would call a long tail play to get your brand in front of your existing retail clients. There are a lot of little strategies behind the scene to make this happen, but focus on your retail clients. That's phase one. The market beyond that, that would be phase two. Just focus on your internal clients first, okay?
Hey, Pam, can this is Sarah. I want to interrupt here because we have a question. And so I kind of
Yes.
need you to answer it in the moment. The question is, how are you dealing with the Facebook special ads category for lenders and real estate agents?
Yeah, great question. So in this case, and let me just kind of explain without getting too technical, this is a way that Facebook is trying to make sure that there's no discrimination happening around credit or race or anything like that. They want to make sure that you're broadcasting this out. We had to do a manual exemption because we are a special ad category because we're B2B, right, at Mortgage Cadence. So for you, it's the same thing. Just know that there's a way for you to engage with Facebook support, explain what you're looking to do and who you're looking to cast a net around. But yes, with special ads like this, they just want to make sure that you're not doing anything to exclude people from this ad that could be a prospect for you. That's a great question. Anything else, Sarah?
Nope, that's it for the moment, but I'll jump in when we have as we go.
Terrific. Good question. Okay, Dan, let's go to KPI number 2, which is all about pull through. We hear a lot about pull through. Very, very generally, it measures how many loan applications were submitted that actually close. So Dan, with that, let's talk about pull through.
Yeah, let me talk a little bit about this calculation. So there's lots of things, lots of puts and takes in the numerator of this equation. We use a broad definition. So it's applications that were submitted to an automated underwriting engine, typically DU or LP, and typically very early in the process. That includes for our study purposes things like what are known in the industry as TBDs, those applications that for the purchase of a home that do not yet have an address. It includes applications that do have an address, refinance. It includes construction loans. So when you see our results, you'll say, wow, that's pretty low pull through. But our definition is purposefully very broad because once a loan is submitted to an automated underwriting engine, it's a real loan, and the potential to close that loan is very high. And we all know that, we're in the loan closing business. We don't get paid until they close. So I like the broad net approach to this definition. And as you'll see in the numbers here, it tends to make the result lower than you might expect. But again, this is a measure of opportunity. If the number isn't as high as you might expect, well, we're probably not closing as many loans as we could.
Okay, so this is really interesting. I want to share with you guys a conversation I hear a lot in my role, which is I hear lenders say, hey, we want to be a Rocket Mortgage. And, in my brain, I'm thinking, no, you don't want to be a Rocket Mortgage, although there are 2 things that they do really, really well that you could model. Dan, what's the first one? What's the first thing that happens?
Well, so yeah, so one of the things that you want to do is, as soon as, assuming that your borrower is applying online, they're self-originating, just as soon as you catch that application, as soon as they've done that, get in touch with them, reach out, call them. That makes a huge difference. The reality is, and Pam, if I'm saying this too early in the presentation, I apologize, but the reality is the longer it takes to get in touch with the borrower, the more likely they are to apply with another lender and another lender and another lender. And when that happens, the opportunity to close decreases by that multiple. So if they apply three other places, you got a 1 in 4 chance, right? So you got to call them right away. So Pam, that's one. What's the other?
Yeah, the other thing that they do really, really well is they are on a relentless pursuit of that business. They know that if they can start to build rapport and a relationship immediately, which is why the phone rings within 3 seconds of the apply now button being pushed, is that they will not give up until that person tells them no. So this is a really key. This acknowledgement immediately is key. We do every year a borrower survey, and when we were talking to borrowers about the how quickly they were hearing from a lender they applied with, only less than a third, right? Took over 24 hours to acknowledge it, and that includes any automation. That's not even just a phone call. Automation. There are lots of great solutions out there that can automate this for you. Just acknowledge receipt. Somebody will be with you promptly. We want to talk to you about where you are on the journey. So
yeah, and keep doing it. I mean, the other thing that we've learned through our study, which is starting its 8th year, those lenders who relentlessly pursue applications all the way through to closing close more of them. So, catching them right away when the application is submitted, super important, and then staying with them, close to them throughout the process, also super important.
Yep, this clarity piece is really key also. When we broke this down by cohorts of first-time home buyer and then age 25 to 29 and lower income, 14%, they didn't understand the process of getting a loan. So while this may seem like a fundamental, it's still something that gets overlooked. I just went through a purchase loan. It got overlooked by my lending institution. There were no questions about, okay, what can I provide for you educationally, right? How can I help you understand the process and really start to manage and maintain your expectations as you're going through this? Really key there. And then this was really interesting too. We wanted to better understand that personalized experience. And Dan, you've heard me kind of mumble about this. I wrestle with that expression, a true digital borrower experience. I think we make the presumption that even younger generation want a fully digital experience. This is actually a very complex transaction. And while that may be true with a lot of digital solutions out there, this is a transaction where everybody is looking for more one-to-one, right? And that's going to happen through conversations. So something to bear in mind as you think about your people, how are they being recruited, trained? Are these actually human-to-human skilled, soft-skilled individuals with high EQ, emotional quotient that can get a borrower over the finish line? That's the difference between a quarter point and a rate. So if people are rate shopping, they're going to go with somebody who's actually going to nurture them through before they'll leave one for a quarter point. So just think about that as you're looking at your competitive landscape.
Well, and I think this is really important too, is, a lot's made of the digital mortgage experience. And I think probably every borrower cohort is interested in online interaction at some level. But as Pam said, this is a complex transaction. Most people, let's just say all consumers, no consumer really understands it, not well, because they don't do it every day, and it changes a lot. This is something that hasn't changed since I started lending. People want to work with people for a mortgage because it's not only complex, it's big and it's scary and it's a lot of money.
It sounds like children, big, scary, a lot of money. Okay.
Probably true. Well, I shouldn't say probably. It is true.
Mine are. Okay.
Yeah, before we go on, I have a question, because on the last slide you have phone and email. Do you guys have any thoughts about which is more impactful, or which someone would like to be contacted first?
Yeah, so I believe it's a combination of the two. This is a really, really good question. If I were to look at the mix here, they're equally as important. Leveraging email automation, that's a set it and forget it deal. I would have loved to have received an email acknowledging the receipt from the president of my bank saying, hey, we're so glad you chose us. We've got expert people on staff. It's after hours, but we're going to get back to you pronto, and we're going to help you get over the finish line. And I would have also loved a phone call that just said, okay, where are you in the buying process? Have you identified the property? And just kind of walk me through it a little bit. Okay, great. What questions do you have? Let me explain a little bit about how we get started here and what's going to be, how we're here to support you through this journey. So I'm big, loyalty is my area of expertise. So this is something, if you want to build loyalty, brand loyalty, this is big money for little effort.
Great insight. Thank you so much.
You bet.
And if I could, I'm a big believer in the welcome phone call. I think that it can't be overemphasized. I think it helps make a big difference in terms of stickiness of the application to closing.
Absolutely. Let's go to velocity. Dan, I hear this a lot from from people that are at that mid-manager level all the way up to the C-suite. They are very focused on getting loans closed faster. So let's talk a little bit about why that's so important to those segments of lending teams and how we calculate it.
Yeah, you bet. So, our calculation, let's start with the math first. And this is simply the number of days from submitted application to closing. Submitted to DU or LP to the day it closes. And again, we use the big number of applications, purchase without an address, refi, construction, so that everybody's in there. I think, and we're going to talk about this in a few moments in a slide that's coming up, is there's a very one-to-one correlation between borrower satisfaction and time to close. And you'll see here, J.D. Power's study of recently made it really clear. On a 1,000-point scale, the highest satisfaction are those borrowers who close in 30 days or less. And you can see how satisfaction drops off as that becomes 31 to 60 and more than 60. In our own discussions with our benchmark study participants, they're pretty universally closing purchase loans in less than 30 days. Pam's going to talk in a minute about some extraordinary cases where they're actually guaranteeing far less than that. And I think this makes logical sense. People are very anxious about closing their transactions so they get in their home, especially with purchase, because if you think about the market today versus several years ago, we're really in a purchase market. I know we've got a mini refi bubble going on right now, but I was just talking with a lender this morning who in 2012 their purchase ratio was like 23%. 2018 it's 71%. Refi loans can take their time to close. They're typically not time sensitive or time bounded. Purchase loans are time bounded. So the faster you get them done, the happier people are. And J.D. Power's survey bears that out.
Yeah, that's really great. I want to share with you guys a case study from one of our clients. They're down in Southern California, and as you guys know, it's competitive market down there, right? It's high prices, multiple offers, and they are able to come into the market and compete with the big guys. Again, this is a mid-market credit union, but they're surrounded by the big boys, right? And so what they're able to do is to train their LOs to go into the market, network with real estate agents, and say, look, we can get your buyer in their home in 13 days. Now, you might be thinking, we've heard a lot over the last couple of years about a 10-day close, and it's not elusive. It is a very real thing. However, it's not automation and technology alone that makes that happen. It's really a combination of a team that works very cohesively together. They're cross-trained so that they can go where the volume is, right? They can move around within the loan production cycle and help each other out and go where they're to prevent any sort of bottlenecks in process. So Dan, this has given them a pretty significant competitive advantage, and that's just one way that they go out into the market, and they've been able to create an exceptional market share from this one little strategy.
Yeah, it does indeed, or it is indeed. If you think about if you're going to guarantee this, it's the difference between does my borrower get the house or not. And in Southern California, obviously, super competitive. I would argue that, probably very competitive everywhere because we do have a shortage of housing. And folks who can get the deal done quicker are likely the ones who are going to win. So I think this is something everyone can employ. And this is a technology play, of course, but it's also a people and process play, as Pam says. It takes all three to make this work, and it makes a significant difference. I can tell you too that this client who guarantees the 13-day close, their borrower share is pretty good. It's higher than average, which is terrific, and this is one of the reasons.
That's fantastic.
Can I jump in here and ask you how they came up with 13 days?
I think what they did is that this team's been working together for a really long time, and I think they realized that was their sweet spot. It didn't create so much stress on the team that they were like a tightly wound rubber band, where stress levels go up. Like they really wanted to maintain a good quality of work environment. And so this became their sweet spot based on the team's capabilities.
Gotcha. And that's still, much faster than the average. So that's a great, spot.
Yeah, it's remarkable and it's really cool.
Yeah. Yeah. So, so let's go into some of the velocity results, Dan, through the benchmarking study and talk a little bit about this. I think one of the more frequently asked questions we get is, you might live in an area, let's say rural, right? And things move a little bit slower there. There are just complexities to it. And so give this some relevance so that people can go back into their data and say, what is our true number?
Yeah, you bet. So, there's a bunch of numbers on this slide, and you can see the range is pretty broad, 32 days to 100 days. And again, this is, purchase without a property, refi, construction. So it's all those. So the days you would expect would be longer. Where you see 100 days, there's obviously some issues there. Part of it's a supply problem. Their borrowers can't find homes, but there's other issues as well. But if you look at the average, of 64 days, that's actually up in 2018 from 2017. Part of the reason it's up is we do have a macroeconomic problem. People want to buy homes, can't find them. There's just not supply. And then you can see on top, the 42 days, and those in the top quartile hit that number. And that's including, those that are TBD, those that are purchased, those are construction, which is pretty darn fast. And within that group, they will say, look, we're closing purchase loans that have a property identified, in 30 days or less, and that's keeping them in the game.
So Dan, can you isolate that purchase number if you just wanted to gauge your team's productivity or speed?
You can and you should. You absolutely should. And I would say, given at the lender level, there's, I would isolate it at, purchase with a property address, determined property at time of application. And I would separate that from, purchase without a property address. And I would separate that obviously from construction. Construction is going to take what it's going to take what it's going to take. And then refi, of course, you would separate that out too. But yeah, and I would look at purchase with a property address, and I would go aggressively after those and get them to close as quickly as possible. I wouldn't forget the TBDs because you got to stay on top of those as well, or those are the borrowers that are more likely to go somewhere else because the transaction's taking longer. That's one reason, but also they're talking to more people who are more likely to steer them to other lenders.
Mm-hmm. Yeah, when I was going through my purchase this summer, they said 35 days is the fastest we can go. And I said, why? Because that's my nature. And they were like, that's just as fast as our team can go. Like, that's the size of our team. And that's like they hit their bandwidth. And I thought to myself, well, there's, knowing the industry, I'm like, there's work to be done there. Because 35 is not, to me, is not competitive where I live in the Denver area. So that's just me, Dan.
Well, another hot market though.
Another hot market.
Can I jump in here just a second? We do have a question that's what's the source of the data, an MBA study, but you guys, so I guess they're asking what is the source of your benchmarking data?
Great
yeah,
question.
I'll take that one. So these are our clients. We've been doing this in addition to providing mortgage technology. We also provide our high performance lending report through our benchmarking study to our clients. So every year we provide these 5 metrics to them. So we've been through 3 of the 5 so far. And what this does is it allows them to look at themselves versus themselves over a long period of time, 7 now going on 8 years. And it also lets them look at themselves versus their peers over that same period of time. And that's where it gets really interesting, because that's when you start using this more as a diagnostic, because you can look at why is this one this way and this one that way and what's making the difference.
And also MBA does measure this, they measure several metrics. Velocity is one, Dan? Yes.
MBA publishes, they publish several. They publish productivity, they publish cost to close, they publish pull through. I'm not sure velocity is one of them. I'm not sure about that.
Got
In their, and I'm talking about in their performance lending performance, their performance study, which comes out quarterly. It's a great piece, by the way. It's a terrific piece of work. It's also a long-running study that's worth, if you're not acquainted, I would encourage you to become acquainted with it.
Thanks for
it.
clarifying that, guys. Appreciate
Yeah,
it.
you bet, Sarah. Thanks. So moving on to KPI number 4, we've got cost to close. This is what we internally call the big kahuna. It's a tough nut, right? Because there's a lot of costs that contribute to this overall cost to close that come from different parts of the operation outside of lending. Dan, let's talk a little bit about how you calculate, in sweeping broad terms, because it's big.
Right. Yeah. This is the one metric out of the 5 that's not simple math. This isn't back of the envelope stuff. This is classic and pretty well straightforward cost accounting. So we look at 4 components of cost. We look at labor, direct cost, indirect costs, and technology costs. So, and that's typically the same format that the MBA performance study follows. And it's tough to get to this number. It's tough to get to a number that you can compare yourself versus your peers, because in your own institution, you'll all cost account a little bit differently. Doesn't mean your answers are more right or than someone else's. It's just that different accountants will approach things and will approach allocations differently. We have an algorithm that lets us calculate the same way for all of our customers, and actually we're close to being able to do it for the entire industry, so that we can compare one to the next. Now, when we talk about the results, and Pam, I don't want to get too far ahead of you here, but what you're seeing on the slide here is, we've kind of deconstructed the components. So the first one is labor. Here's what's important. Labor is 50% of the cost to close. It's at least 50% of your cost to close. And I want you to just kind of focus on that and tuck that away for a minute. Critically important that you know that. Now, the other 50% of cost to close, between indirect costs and direct costs, that makes up another 40% to keep the math simple. So, if you're talking about direct costs, you're talking about things like occupancy and equipment. You're talking about ongoing professional fees. You're talking about other OPEX, training, travel, those types of things. So costs that are directly attributable to, your mortgage team that are not labor are direct costs. And then, if you want to break it down a little further, that's about 20% of the total cost to close. Another 20% is indirect costs. We show it here as, corporate allocation. Accountants get mad at me when I say this, but think of that as the corporate tax. There's nothing you can really do about indirect costs because those are given to you. Just like there's not a lot you can do with direct costs because those are a result of the team that you have. You can't really affect those directly. You can affect them indirectly, but not directly. And then the last 10% is the cost of technology. So it's the smallest piece of the cost to close. And it's always been the smallest piece. It's never been, it's been as low as 5%. I think right now it's between 7 and 10%. But back to the most important thing, the cost you can control is labor, and it's 50% of the cost to close.
So this, to me, it always begs the question when I see this, because of course, as a technology solutions provider, we're always talking about pricing, right? And the competitive landscape around LOS, the price for an LOS. And I think to myself, oh my gosh, it's only about 10%. The thing to look at is the labor piece. Like if you really want to reduce that overall cost to close, you can't ignore that labor. And if the technology doesn't offset the cost of labor, then I'm not really sure that you're working on the right end of the scale.
Well, and that's truly the play, is if you look at, as we've broken this down, direct costs and indirect costs, those are really not things you can lever to address your labor cost. Technology is. Technology is the tool that that should be helping you with your labor cost, and we'll talk about that in a minute.
Okay, great. So let's
can I
get through.
just jump in here? I have a couple more questions.
Great, Sarah, thank you.
Lots of questions coming through. One question is, how many lenders are in your study, and what is the size of the population that you are benchmarking?
Yeah, so lenders in our study, it's about 75 at this point. When you say the size, are we talking about the size of lenders?
I don't know. I don't.
Okay. Yeah, I would say the size of lenders is pretty broad. So, from mid-size to quite large.
Great. Another question based on what you just shared was, what options are there to automate the labor? So you were just talking about the cost to close. What options are there to automate the labor?
Yeah, so that's a really great question, and it really is the question. What I would say to that, broadly, and I can drill down a little bit in the time we have. What I would say to that broadly is, I would say technology, generally speaking, is very underutilized. It's not leveraged to the extent that it can. So if you were to look into your shop today, and this is where the whole process component of people and process comes in. If you were to look into your shop today, I would focus on, if I were to go back and lend, I would focus on what are the things that my team are doing that that are very redundant, that are very very basic. And I would say, the question I would ask is, why isn't my technology doing that for me? Is it because it doesn't, or is it because I haven't enabled it to do it or permitted it to do it? And generally speaking, for those types of things, the technology hasn't been enabled to do it, or it hasn't been permitted to do it. So that's where I would start. But start with the hypothesis that all technology is under leveraged, and see what you can make it do that it's not doing. I'll go one step further and say I would really look at some of those very redundant, very consistently redundant tasks are compliance related, and we're probably not leveraging the technology enough in the compliance sphere. And I think we know that because we saw a huge hit to productivity when things like the qualified mortgage rule, TRID, HMDA, when all those came up, productivity plummeted. And I think that that's an indication to me that technology will help with that, but it's not being utilized to the extent that it could be to help with that.
Thanks,
And Sarah, I could talk about that all day, so I'll stop.
And I've got a couple more questions, but I'm going to let you guys go through, the rest of what we have, and then we can come back to them. That'd be great.
Okay,
Great,
so
thanks.
Pam, if you want me to hit these pretty quick, let me go through this. So
sure.
You'll see here benchmarking study range, broad range of as low as $1,500 to close a loan, and as much as $18,000. The study averaged $5,600 in 2018. To put that in context, the MBA in 2018 reported about $8,900 in cost to close. And to put it in even broader context, if you go back to say 2012, it was under $3,000. What I would say is, look, the cost to close a loan, we talk about it all the time. We obsess on it, but we still haven't driven it down. We're kind of stuck at a level in our group. We're stuck at a level of about $5,600 on average. MBA until the end of 2018 was more stuck in around call it the $8,500 average range. It looks like it's decreased in 2019. That's good, but we're not working hard enough to drive this cost down. I'll give you the trick to that in just a minute. You can also see that our benchmarking top quartile, about $3,200 alone. Why this is so important? I mean, it's obvious. This is profitability. If your cost to close is low, your profitability is going to be higher. More as importantly, it also gives you pricing power with your borrowers. Every $1,000 you can decrease cost to close is about 10 basis points in rate. And you think about that, that's a lot. So if you can go down $2,000 in cost to close, it's 20 basis points in rate. It's almost 1/4%. That's a big deal. And not only is it a big deal from a competitive standpoint, you're doing your borrower a big favor too.
And ultimately, I think it's worth noting is that the cost to close is, to me, the byline in these 5 KPIs, because if you're doing the others efficiently and effectively, cost to close will naturally be driven down. Fair, Dan?
It's true, and there's one to obsess on, however.
Here we go. Let's
and here it is.
obsess.
Yes, well, being somewhat obsessive compulsive. So, the industry, as I said, it talks about cost to close, and we've been talking about the high cost to close, frankly, for a decade. And the thing is, as I said, you can't do anything about it by obsessing on it. It's a number you cannot move in and of itself. The way you move it is through productivity. And the reason that works is productivity is your labor component of cost to close. 50% of your cost to close is labor. If you drive productivity up by 50%, your cost to close will go down somewhere between 35 and 40% predictably. They're that related. So we know that if you want to drive your cost to close down, get your teams more productive. That's a technology. There's a technology component to that. There's a process component to that, certainly, because it's not all technology, and there's a people training component as well. And where we have lenders who have focused on productivity, they get great results, and we'll talk about that here. So our benchmark study averaged 3.33 for 2018 versus about 2 for the MBA average. The benchmarking top quartile 4.12. And you'll see here that our top producer was closing 10 loans per employee per month in 2018. That's a lot. Maybe a little too high, but more power to them. They're doing it, and their cost to close is under $1,200 a loan.
Does that require a lot of Xanax, Dan, to do 10?
Well, I think, I do think, all kidding aside, I do think after, doing this study for so many years, I do think there is a theoretical maximum given market conditions. And those market conditions are things like, what's the compliance environment? What's the purchase environment? When you're doing more purchase loans, the more purchase loans you're doing as a percent of total has an adverse impact on your productivity. Purchase loans take more work. I mean, it makes logical sense. So, I do think there's a theoretical max on that number. I think 10 might be it. I've not seen anybody go higher than that. So I would look, if I can get my productivity to 5 or 6, I'd be thrilled.
Terrific. So let's recap on high performance lenders, and then we're going to do one more on productivity. Track labor costs against volume. Again, that goes back down to that labor and the cost to close. Yes? Making sure that that's equitable.
Absolutely.
Hire people, cross-train them across the team, and create an irresistible culture. What we find is that when people have been working together for an extended period of time, they're able to dial up together and create lift within the team. So make sure that you're creating an environment. As a matter of fact, we've got this one client, they actually underpay this team, but it's such a great place to work. People are like, I would rather work here than go somewhere else and risk being unhappy with my coworkers. So there's a little bit of a interesting fact there. And then be sure to define and communicate strategic goals, because these are the frontline employees. They're the ones that are actually going to optimize the entire experience, not just on the line, but for that borrower experience. And they're the ones that are driving the tactics that support the strategic goals. So Dan, a little bit on this one.
Yeah, so as I said, obsess on productivity. And as I've said already, productivity is the only way to control cost to close. Because if you think through the math, 50% of cost to close is labor. So if you improve the labor component through increasing productivity, you'll also be able to address things like the direct costs, things like how much space you're using, how many people travel, how many people you're training. All the direct costs become more manageable once you manage productivity and the labor costs. So obsess on productivity. If you take one thing away from your time with us today, take that away. Now, the other benefit of obsessing on productivity is those lenders who have consistently higher productivity have consistently higher borrower share. And this started showing up 2 years ago in the data. And it was 2 years ago as a curiosity. It was like, oh, that's interesting. Those folks who are consistently high producers in terms of productivity have consistently higher borrower share. Isn't that interesting? By as much as 50 basis points. It happened again in the 2018 study. So then I went back and I actually did the math. And it turns out that there is a correlation between high productivity and borrower share. So not only do you get to reduce your cost to close, you also will likely increase borrower share if your productivity is higher. And it logically makes sense. If you're really good at lending, people are going to want to borrow from you. The word will get around. People are going to want to borrow from you. And I think, being really good at lending, I think the best proxy for that is probably productivity.
Wonderful. So this is our big giveaway, you guys. You can get a KPI report for your business today. Reach out to heythere@mortgagecadence.com. In the subject line, drop in KPI report, please, and we'll whip one up for you pronto. Also, I wanted to make the offer before we jump off that if you would like to connect me with anybody on your marketing team to talk a little bit more about that borrower share strategy, happy to spend some time with them explaining that. So please don't hesitate to reach out. I'm going to give you my email and Dan's as well in the last slide. But Sarah, any other comments, questions?
Hey, Pam, can I come back to something you just said?
Yes, sir.
So the second thing I would, if you take two things away from your time with us today, one is the obsession on productivity. The other thing I would obsess on is the social media marketing play Pam's talking about. It works, and it works because it catches borrowers in the moment. So I would take her up on that as well.
Terrific. Sarah, anything else?
Yeah, absolutely. We do have some more questions. So just know that if you asked a question and our Pam and Dan didn't get to it, they will reach out directly to you to answer that. But there are a couple. There's one that I'd like to ask that's probably for everyone. Do you have insights on KPIs at the process level? So in other words, could you say something like underwriting, the turn time for initial credit decisions, or for the correspondent channel, the pre-purchase audit turn time? Is that the kind of KPIs that you guys can measure?
We can't at our level, or we haven't at our level, not yet anyway. I think the future generation of this that we're building will get there, because those do get critical. I mean, those do get very diagnostic, but we're not quite there yet.
Okay, great. And then the last question we have time for, I think, is after LO compensation, which role commands the largest share of the labor costs? I think
that's a great question. So, and it's an interesting question. So, LO cost, obviously, it's the biggest. What's changed over time, and probably no surprise to anybody, since the regulatory environment has become so complex, the next places are going to be management and QC.
Thanks. Yeah, I appreciate that so much. And I just want to, we've come to the end of our time for the webinar today, but I just want to say thank you to both you and Pam, Dan there. Thank you for that very informative look. And if you submitted a question, again, the panel can reach out to you. HousingWire will be sending out the webinar recording and the deck to all registrants within the next 24 hours. And you can also look in our Knowledge Center. It's available there along with other webinars and white papers. Thank you for joining us, and we hope you have a great day.
Thank you, Sarah.
Thank you.
Thank you.